Tell us a little bit about how HUD is financing affordable housing developments now. What are they? What is each one, and how do they differ among one another?
For each HUD loan program, there are different requirements. You have a private developer, you have the federal government in the form of the Department of Housing and Urban Development, and it acts through the Federal Housing Administration. And the lender, though, will actually be a private bank. And so you go to an FHA lender, a HUD approved lender, to get one of these commercial loans. So a 221D3 is the most common. That's a new construction loan. You go through a series of regulatory underwriting processes, and you satisfy the U.S. Department of Housing and Urban Development that you are meeting a housing need in a particular neighborhood. So you have a market study, you have a needs assessment. You could charge market rent as long as it's in an area that needs housing. And if you satisfy all the underwriting criteria, the physical planning, engineering, architecture, once they approve that, you go to HUD closing, the note that the borrower signs gets endorsed by the Federal Housing Administration. It guarantees that note's repayment. You get a lower than market rate interest rate on your loan. So the 221D3 is a family program primarily intended for multifamily construction. It can also include some seniors units, and all these HUD loans are non-recourse loans. 221D4 program, that's for new construction, is really aimed at creating housing that is affordable for low and moderate income individuals. And moderate income, which is up to 120% of area median income. So if the project where your goal is to serve more than half of the units are people who earn at or below 120% of area median income, and of those 50 plus percentage, the majority are retained and dedicated to people earning at or below 80% of area median income, you meet all of the other regulatory requirements. You will be perfectly fine with HUD. Then they'll say, let's use a 221D3 loan, build your project. Then if things are going well after about 10 years, we'll do a 223F refinance, because you can pull equity out of that 223F if you need to. The 223F can't be used for new construction. It can be for acquisition, provided it has a substantial rehabilitation component, or it can be used for refinance. With refinance, rehabilitation is not required, but sizing of the loan can be anything over $3 million. It can't be under $3 million, but loan terms can go to 35 years. There's no 40-year AMs on those. And it's got a maximum 75% loan to value ratio for that particular product. That's why the underwriting numbers align with its intended purposes.
Okay, welcome to another episode of Affordable Housing and Real Estate Investing. Today, guys, I am so blessed. We have Michael Eaton on the podcast today. And when I first found him, I know that he has closed over hundreds, like 300 plus affordable deals. And I knew that he had such a wealth of experience, and he's so giving, such a kind gentleman from the first time I ever talked to him. But he's been willing to come onto the podcast and give us a deep dive into all things affordable financing. And today, we're going to be covering what was the old style public housing, what kind of HUD financing there is. And if we have enough time, we're going to get into low-income housing tax credits as well, based on Michael's experience. But we're going to see how much we get through today. So, Michael, welcome to the show, man. How are you doing today?
Hey, how's it going? I'm getting over an allergy-induced sinus infection, but I'm alive and well and on the mend. So I'm ready to go. If I sound scratchy, that's why.
I'm so grateful you came on anyways, Michael, because man, you could have said, hey, I'm feeling too sick and I can't do it. But
nah, no hill for a climber, right?
There you go.
So this whole affordable housing thing was not a planned career. I will tell you that. This is very much by happenstance. I started out adult life as a lawyer in Dallas, doing all variety of business related finance, securities, tax, and real estate, and started doing more real estate development, multifamily, did a couple of skyscraper office buildings around, a lot of kind of mid-rise warehouse office space stuff, the stuff that doesn't have a lot of sex appeal, but frankly drives the economy in a lot of areas of the country. And then when I was still a baby lawyer, I had a real estate developer client come to me and say, hey, do you know anything about this, what then was new, Section 42 of the Internal Revenue Code? And being truthful, I said, why, no. I don't. But I always liked complicated things. I had a lot of natural science in my undergraduate studies. And so I said, it's complicated, let's dive in. And it turned out, as everybody knows, Section 42 is what created the low-income housing tax credit. And I ended up working with that client and closing one of the first 5 tax credit projects in Texas in 1987. And that ended up being one of the first 20 in the United States. And it kind of depends upon if you're counting on when the deal closed, when certificate of occupancy was given. So people they all jockey about that nonsense. But anyway, I was in the front row for that kind of stuff. And it really kind of whetted my appetite for affordable housing generally. And later in life, I went back, after I practiced about 10 years, I went back into a doctoral program in economics at the University of Texas. And then as I was coming out of that, I began working with some community development corporations, and also was fortunate enough to be mentored by a dear friend who's Norman Nelson, aka Happy Nelson, who is one of the most accomplished HUD lawyers in the entire history of the United States in Dallas, and learned a lot about internal HUD loan processing and programs as part of the affordable housing milieu, and kind of went from there. But kind of like as life goes on, you remember things from your childhood that kind of come back and kind of make little appearances. And those happen to me from time to time and keep reminding me that there's some universal method to a lot of the madness that I've encountered in my life that seemed very random and chaotic. Because when I was a kid, my family's been in Dallas for many generations, and we would go to my great-grandmother's home that was in Oak Cliff in those days. And we would have to drive across the Trinity River. And as we drove across the Trinity River on the bridge that was there on Hampton Street, you would see these buildings that were on either side of the Trinity River that were very foreboding and gray. And I remember as a child asking my mother what those were, and she would always say, those are the projects. And I was like, well, what does that mean, the project? And she said, well, that's where people that don't have enough money to live anywhere else have to live. And just the idea of that and the visual impact it had on me left me with a lengthy and longing sadness that I literally felt kind of in my soul for a long time that I didn't realize until much later in life. And so as I started working back in industry and working in affordable housing, it just became apparent to me that I needed to use the technical skills I had to try to promote development and creation of affordable housing, because I had worked with and had quite a few friends who were in the single family residential construction field. Many of them who were wildly successful and financially very well off. And the thing that they kind of had in common was, this is not generous, I'll say that, is that none of them was especially bright. I mean, these were not intellectually curious people. They were not analytical thinkers. They weren't even deep numbers people. They just kind of knew a trade, and they expanded it to the point that I can manage this group of workers, and I can build these houses, and I can build these houses for $130 a foot and sell them for $260 a foot, and I'll get rich doing it. And a lot of them did that. And I thought, well, if people can do that and they don't have the greatest aptitude in the world, why can't we take people of similar accomplishment and kind of give them a little bit of a turn and show them how they can have a personally successful career while creating housing for the bulk of the population, which is the people that can't afford to live in the $300. Back then, $300 a square foot was an expensive home. Nowadays, it's like the last tax credit deal that I did in Virginia cost over $300 a square foot for 40% of area median income residents to live in. So inflation over time does a trick on you. And so I've tried to foster education about affordable housing alternatives and modalities over the years as much as I've tried to create and push creation of affordable housing in every way I can. You mentioned the public housing model. That's where Section 8 originated, right? They called them the projects because it was a project created under Section 8 of the Affordable Housing Act. And Section 8 of the Affordable Housing Act said money is going to come directly from the coffers of the federal government, from the Department of Housing and Urban Development, into a locally created public housing authority, which public housing authorities didn't even exist until the 1960s. A few places the late 50s, but mostly the early 1960s. And then they got the money directly from the federal government and utilized it to actually construct and manage their own low-income assets. The inherent problem with that model from the outset is that public housing authorities were not created to be solvent. They weren't created to be liquid. They were created to be conduits of federal funding. And so they didn't have any means by which to generate sufficient revenue to pay for deferred maintenance. All they got was money from the federal government to build an asset. And then the people that lived there paid 30% of their subjective income. And that was all they were required to pay. There wasn't any, you didn't even have to worry about what a market rent would be because you're not going anywhere. These weren't vouchers to go anywhere else. You're just living in the project. You pay 30% of what you make. You live in this place. We take your money and we use that to pay for operations, but it's not enough to pay for any kind of improvements, certainly. And it's really not even enough to pay for maintenance. And so there's a lot of deferred maintenance. And through the 1960s, and in particular in the 1970s, you saw really catastrophic degradation of public housing assets in large metropolitan centers around the United States, in New York, in Philadelphia. Wow. In the South and Southwest as well, but just because the population wasn't as great or as dense, that they weren't as humongous, just size-wise. And then, of course, kind of the, Moby Dick of public housing. It was the Cabrini Green public housing in Chicago, which was notorious because at one point in the late 70s, early 80s, Cabrini Green was so dangerous that city of Chicago police officers would not enter it. They just said, if there's a police call, we're not going. It's too dangerous. Everybody there has a gun, and that's back before everybody really did have a gun legally. I mean, they were rife with crime, a lot of drugs, prostitution, gun running. I mean, you name it. And all that was going on in this public asset. And so ultimately they had to tear that down. But when you take people that have very little hope and they have very few assets and they have very few resources offered to them, and you put them in a place that looks like a penitentiary, I don't find it especially surprising to learn that they act as if they were in a penitentiary, because that's really what we're doing. Is we have created a system of economic segregation that is every bit as odious as racial or ethnic segregation that we had until very recently in many parts of the country. Everybody talks about, segregation's been gone. Well, not so much,
And Michael, would you say it's fair to say that with the early forms of public housing, it spurred supply, right? But because maybe they didn't underwrite effectively, or they just underestimated all the maintenance that would come along with it, or they underestimated the fact they were putting communities together without, like you said, the resources, the wherewithal to progress out of that situation, you put people in a situation that they cannot necessarily climb out of without significant support, was what it sounds like.
Yeah, I mean, it's always easy to Monday morning quarterback or retroactively say, here's how everything was done wrong. I think when public housing assets were initially created, it was probably about as good an idea as could be had at the time. Oh, yeah. We're going to take these dollars, we're going to spend them locally. We're not going to spend them at the federal level. We're going to dole them out to these local housing authorities and have them spent locally. And then those local dollars being expended are going to create assets for people to live in those local areas. That part of it is probably pretty good, to be honest. The problem is nobody thought what happens 30 years from now, because nobody in the federal government ever thinks what happens 30 years from now. They just think what happens 2 years from now, because that's the election cycle. Because even though senators are there for 6 years, a third of them are up for election every 2 years, and every member of the House is up every 2 years. And so 2 years is kind of the length of memory of anybody in the federal government that has much impact. At the presidential level, to be perfectly honest, it really has been going all the way back to Lyndon Johnson since we had a president who affirmatively, in a positive way, managed housing and urban development and pushed for creation of opportunity. I mean, LBJ is the one that created the war on poverty. And for all his peccadillos and horrific decisions in Southeast Asia that were made, I think it's worthwhile to note his legacy in terms of the Civil Rights Act and the Voting Rights Act, and the expansion of housing opportunity, the creation of Medicaid and Medicare in the United States. None of those would exist but for him. And I think a lot of his progressive thinking was moving in the right direction, but nobody thought, gee, we create these public housing authorities. How are they going to be able to fund themselves? Everybody thought, let's just kick the can down the road and we'll figure out a way somewhere down the line. I think if you go back and you look at some of the legislative notes on those things, people were thinking that public housing authorities might actually be taxing jurisdictions at some point, so that a housing authority could charge a tax in a local area and that would give them revenue to be able to take care of their assets. If that was the case, that would be fine. And I actually think in some parts of the country, that would be a pretty good solution in some ways. You know, making everybody that goes through some city pay an extra quarter of a cent in tax is not going to have that much of an effect on the demand for goods and services in terms of cost increase, but it would have a significant impact in terms of raising revenue for an ongoing public housing conduit kind of financing. Having said that, HUD finally realized in more recent years that the model of traditional public-owned public housing was really not a long-term solution. In the 1980s, housing choice vouchers, they weren't called that then, they were just called Section 8 vouchers.
So, Michael, now we're on HUD financing, right? Because we talked about the old form of affordable housing. Tell us a little bit more about how HUD is financing affordable housing development now. I know before you told me about a couple of different types of loans, but let's list them out first. What are they, Michael? And then let's go through what is each one and how do they differ from one another, along with the pros and cons.
For each HUD loan program, there are different requirements, and it's not really worth going through the specifics of each requirement, but I can give you kind of a general overview. The most important thing to recognize is this is a creation of another public-private partnership. It's kind of a tripartite public-private partnership because you have a private developer, you have the federal government in the form of the Department of Housing and Urban Development, and it acts through the Federal Housing Administration. And the lender, though, will actually be a private bank. And so you go to an FHA lender, a HUD-approved lender, to get one of these commercial loans. So a 221D3 is the most common. That's a new construction loan. And the easiest way to think about this is you go through a series of regulatory underwriting processes. And by doing so, you satisfy the U.S. Department of Housing and Urban Development that you are meeting a housing need in a particular neighborhood. So you have a market study, you have a needs assessment, you charge affordable rents, but on a 221D3, you could charge market rents as long as it's in an area that needs housing. And if you satisfy all the underwriting criteria and you satisfy the physical planning, engineering, architecture criteria, HUD, I mean, it gets down to the screws. I mean, HUD goes over all the plans and specs. They have an internal construction and engineering group that reviews everything with a very scrupulous level of detail. But once they do approve that, when you go to HUD closing, what happens is the note that the borrower signs gets endorsed by the Federal Housing Administration. And so the local HUD office endorses that note. And what it does when it endorses the note is it guarantees that note's repayment. It says you've met all of our underwriting requirements. Therefore, if you, Mr. Borrower, default on the note, we, the federal government, guarantee this commercial lender over here who is actually funding the money for this particular HUD loan that they are going to be repaid. And because it's to the extent that the cost of money, interest, is one part of the cost of money is simply forbearance, right? It's the lack of use of money, the cost of using the money. But another equally large, and in many instances in private lending, sometimes very large component of interest is risk. Part of the cost of borrowing the money is how much risk it constitutes to the lender that they are in fact handing money to someone that they do not control completely. When the element of risk is eliminated because they know if there's a default to be repaid, then only essentially pure interest or the cost of forbearance of that money is what's charged, at least in theory. But in reality, what it really means is you get a significant discount on the interest rate. And so you get a lower than market rate interest rate on your loan in exchange for going through this HUD underwriting program. So the 221D3 program is a family program primarily intended for multifamily construction. It can also include some seniors units, but it's not a seniors program. There are three, really, two especially, but three potentially other HUD programs that are for seniors.
So on the 221D3 loan, I really want the audience to understand that when you said that the federal government is endorsing the loan, they're essentially like insuring, right? Would you say that's
insuring? They're insuring the loan.
Yeah.
The endorsement that they give acts as essentially a policy of insurance for repayment.
And
Exactly.
I really want to hammer home for the audience, right? Because when you have a federal government that's insuring a loan, that takes risk off the table from the lender. And when they take risk off the table, then that's how you get 35-year, 40-year amortizations with non-recourse on the debt, because there's somebody else that's going to come in and guarantee the payment of loan in case there is any default, which is why it's so advantageous of a
strategy. And all these HUD loans are non-recourse loans. I would point that out. Non-recourse. They don't require personal guarantees, and a personal guarantee would almost be, meaningless in the context of a HUD loan because the government's guaranteeing loans. So why would the lender care if you personally are signing a guarantee when the federal government's backing it up, right? It's not like you're going to be a competitor to the federal government in terms of a payment source.
Well, all those pros, right, that you just talked about, Michael, sound amazing, right? Great interest rates, great amortization, non-recourse. Someone's going to be like, well, Michael, that sounds too good to be true. What are there any cons of a HUD loan? I heard that.
Well, the cons are
12 months.
Kind of a traditional loan, and the private lender gets to establish what the loan to value ratio for any particular project is. So it may be an 80-20. It may be an 85-15. You're not going to find any 95% financed HUD project. HUD's not going to endorse a loan that pays for 95% of the total construction costs. They want to see part of the underwriting process is that they are able to see that you have skin in the game, as it were, but not merely skin in the game, but skin in the game in a way that they're confident about the outcome. I mean, it would be possible for somebody to scrape together money to close a HUD loan in terms of just the numbers, but they still might not be able to close because HUD has to be satisfied that this isn't all of your assets are not going into like giving them money to close this one deal. They want to see that you are, in fact, an ongoing business. As a matter of fact, one of the essential parts, the first primary part of any HUD underwriting exercise is what's called previous participation certificate. And it's where an individual company that purports to be a developer tells the Department of Housing and Urban Development, these are all the past projects that I have experience with. And in particular, these are the past HUD projects that I've had experience with. That's one of the circumstances where, not unlike tax credit development, you can essentially rent expertise. So if you have a developer that's built a bunch of stuff, but he's never closed a HUD loan, you go and find another developer that has closed HUD loans, and you say, I'm going to pay you to be a consultant on this job so that I can use your name and your experience on my previous participation certificate. Is that okay with you? And they'll say, sure, but they have to be more than just a name. I mean, they have to show up at HUD, and they're going to have to be at the pre-construction conference, and they're going to have to appear at least through closing to be an actual active member of the development team. But yeah, that's really the only con, except for the process. The process can be slow and the process can be burdensome because, I mean, it's a federal government bureaucracy. So when they start asking for documents and details, they're not shy about it. And a lot of people that are used to this kind of laissez-faire approach to private finance and construction go in and say, man, I don't want to give them all that. It's like, well, then you don't want this loan. If you want this loan, this is how you pay for it. You pay for
Michael,
it by disclosure and information.
I love how you mentioned that you can rent sort of credibility, if I were to use that term, because for people out there that have never done a HUD loan and they hear about how advantageous it is, and they realize, hey, I've never built a project using a HUD loan before. So does that person that they're renting the credibility from have to have closed a HUD loan for new development perspective, or could they have just closed on a HUD loan for, let's say, a really big value add rehab on a multifamily property? What does that requirement look like?
Well, that's a really good question. The previous participation certificate goes to central processing, which is HUD in Washington, D.C. And it's kind of a black box. They don't really tell you how they're going to analyze things. I will say, if you're applying for a 221D3, it's best if somebody on your development team has closed at least one 221D3 loan. If you're trying to do a 223F refinance or acquisition and rehab, it's best if you've had somebody do one of those as well. It's not a condition precedent to gaining the loan, but it will make things easier for you because they may come back and say, we're satisfied with your team. You can go to the next, the next round of documents, or they may say, we're going to need some more information on your previous participation. We need some more experience here. They're usually fairly open about it, but unlike private lending, where it's an ongoing underwriting process to gain approval, with HUD, you actually submit an application and then you just are kind of waiting. And then you have to wait and then you supplement the application as you are requested to do. But you're not in a position where you can just say, hey, do you need anything else? Hey, do you need what else now? What can I do? There's not nearly the kind of give and take that you would find in a normal private lending circumstance.
All right, thank you for that answer. Because then now we understand, hey, maybe you should look for the entity that has closed these loans before. But maybe one more question. Let's say they just started the company, they have experience, they have the financial wherewithal, but they say, hey, why can't I just hire a president of construction that has closed on a HUD loan before? Can you hire an individual on your team and that will qualify as the experience potential?
Absolutely. Okay. As a matter of fact, that's one thing I've specifically done many times. If I'm going in on the front end, I'll have a contractor, let's say, that's done a bunch of HUD deals. It's really important that a contractor that is doing a HUD deal has HUD experience because the HUD construction process is much more rigid than a typical lender. If there is anything, I mean, literally anything changed from the plans and specs, you have to have a change order request. As a matter of fact, if you have a weather day, if it's raining cats and dogs and you can't do construction today, you have to get a change order request from HUD to not be in construction that day. So it's very strict, but the benefit that you get in exchange for that strictness is the much lower interest rate. And the fact that you get one of the things that's kind of beneficial is when you close a HUD deal, U.S. Department of Housing and Urban Development gives you a standard sign and you get to go plant that thing out there. And it says this is being financed through the U.S. Department of Housing and Urban Development. So it gives you a level of credibility and kind of institutional strength to project to the community that you don't otherwise get if you're borrowing from a private lender.
Wow, that's really interesting. And that's really cool because I'm assuming it's so rigid because the government understands that they're insuring the loan. So they want to make
Yes.
sure everything is taken tied because they've taken on significant risk. So they got to make sure that you are even doing change orders on a weather delay for one day. Okay.
Yes. Oh,
That makes
yeah.
perfect
Yeah,
sense.
that's it. They go over that like with a fine tooth comb at the pre-construction conference. And contractors that are used to it, it's no big deal. But if you have somebody new, they're like, what? Really? I didn't know that. I mean, I had a guy some years ago, it's been a long time ago now. He was building an apartment project in Grapevine, Texas, and it was a 221D3, and he thought he had some extra money, and so he put a fence, wasn't a big fence, but he put a fence around the swimming pool, and the pool was a gunite pool, so it wasn't a preformed fiberglass one, and so he made it like 2 feet longer and a foot wider than it was going to be for these apartments, so a little bit nicer, and it did make a difference. But at the end, I still remember at the closing conference, the guy, head of construction, looked at him and said, I hope you like that. And he said, oh, I do. He said, because you're paying for it out of your own pocket. You're not getting a draw to pay for any of those expenses. That's coming out of private funds. So part of the developer fee got eaten up, a fence and a few extra feet of a swimming pool.
Oh, whoa. What a lesson learned, right? Don't assume
Yeah.
that it's all going to be okay, for lack of better words,
Yes.
right?
Now, with HUD, it is definitely not the case where you should ask for forgiveness instead of permission. You have to ask for permission or there will be no forgiveness, is what it amounts to.
Well, Michael, you mentioned about the developer fee. What have you seen in terms of the cap on developer fees on a 223D loan? What have you seen been improved before?
Let's see. They're not giant. I will say that because most of the HUD programs are essentially the idea is that you're building a project to be an ongoing successful project, and the bulk of your economic benefit as a developer and owner will be from net operating income. You get a developer fee, but it's usually less than 10% of the total loan. And a lot of it depends upon the size of the project. If you have a small project, they might let you get away with a little bit higher percentage than with a larger one just because of the, reality check of numbers these days. Mm-hmm. But if you have like a 150 unit project, the chances of you getting more than probably a 5 to 7% developer fee are pretty slim in that scenario.
Well, that's good to know. 5 to 7% is a pretty good range. And do you typically see developers deferring their developer fee on HUD loans? Or
no, they don't typically, because if you were to defer, unlike tax credit development, where the deferred developer fee is actually a source in the sources and uses, a deferred developer fee in a HUD spreadsheet is not a source of funds. It's just an unpaid obligation of the project. And so HUD doesn't want to see any unpaid obligation. They treat that the same way that they treat paying a vendor. It's like, we want all these accounts to be closed out at CO, then we'll go from there. So that's why the margins are smaller. But most of the people that have been successful in developing HUD properties have done multiples and kept them. They have not flipped them. HUD properties don't flip that often, to be honest. Whereas you find just the opposite with LIHTC properties, for example, where the primary economic motivation is the developer fee and not the net operating income. So once the developer fee is earned, most developers don't really care too much. I'm not going to say they're uninterested in the outcome, but they're not as vested in the ongoing operations as they would be. And they're ready to get out at year 15 if they can, at the same time the investors do.
Got it. And how about, let's move on to this other HUD loans, right? We got 223F. What is a HUD 223F loan?
A 223F is a loan that is exclusively to be used for rehab, for acquisition and rehab, or for refinance of an existing obligation. So you can take an existing obligation and just refinance it with a 223F without any rehab. That's possible. It's rare that happens, but it's possible. But the program's written so it can just be a refi, so that you're just lowering interest costs. Most of the time, it's been involved in them, it's where somebody finds like a C plus asset and they go in and do a 223F acquisition and rehab to add a little capital value, new roof, new HVAC, paint and carpet, and start renting them again. But it can also be used for just if you own the property already, if you just want to refinance it and do a little rehab without transferring ownership for that specific kind of project. And both is primarily targeted for multifamily, but it can also be used for duplexes and townhomes. In theory, 223 can be used for like a string of single family rental homes, but they would have to be rental. And I don't really see the applicability of it in practical terms.
So you could build a home. I mean, you could build an apartment building, I guess, Michael, for using a HUD loan. And then once let's say your prepayment penalties are all kind of up, you can refinance into a HUD loan, enjoy the same higher leverage, enjoy the same HUD insurability, but then also get a very favorable amortization schedule. That would be a great application of a HUD loan.
Yeah.
Okay.
Yeah. Fair enough.
Or you could just get like a traditional, I guess, like conventional construction loan, and then we can refinance into HUD loan afterwards as well, right?
Yeah, actually, kind of one of the executions that just popped up within about the last 3 years that's been very popular has been a combination of a HUD 221D3 loan and 4% tax credits. And it's where the bonds that have to be issued in conjunction with 4% tax credits are issued at closing. And the bonds are essentially just used as a construction loan, and they are defeased at the end of construction. And then after they're defeased at the end of construction, the entire indebtedness is turned into a 221D3 HUD privately administered loan.
Okay, welcome to another episode of Affordable Housing and Real Estate Investing. Today, we are continuing our last conversation with Mr. Michael Eaton. We were just picking up of HUD loans. And Michael, I think we were talking about 221F loans, where it's for the acquisition and a rehab. Maybe I can lead off with a question in terms of what kind of strategies have you seen work best with a HUD 221F loan?
Here's the way HUD lenders will sell you an idea. They'll say, let's use a 221D3 loan, build your project, and then if things are going well after about 10 years, we'll do a 223F refinance, because you can actually take cash out of that 223F. You can pull equity out of that if you need to. The 223F is intended to be, it can be used only for, it can't be used for new construction is really what it boils down to. It can be for acquisition, provided acquisition has a quote unquote substantial rehabilitation component, or it can be used for refinance. With refinance, rehabilitation is not required, but you can be. The sizing of the loan can be anything over $3 million. So it can't be a little bitty house loan. I shouldn't say it like that. That sounds privileged as hell, doesn't it? It can't be like a $2.5 million house loan. No, it can't be under $3 million, but loan terms can go to 35 years. There's no 40-year AMs on those. And it's got a maximum 75% loan to value ratio for that particular product. So that's why the underwriting numbers align with its intended purposes. So if you're acquiring something and you're going to rehab it, they want you to be putting a substantial amount of equity into the acquisition. And if you're refinancing, they just will only allow you to refinance 75% of the value that you have there.
And when you talked about 10-year term earlier, Michael, is that because you want to wait until the prepayment penalties kind of wear off first before you finance?
Yes.
Okay.
Yes.
Got it.
Yeah, exactly. And that's usually about the time period where all the prepayments have burned. And you also, by 10 years, the thing is, if you build a good product, 10 years in is really when it ought to be rocking and rolling. It should look great. It should be people that have lived there a few years are happy to recommend it to other people. Isn't old enough to have accumulated any significant maintenance issues, or certainly shouldn't have any deferred maintenance issues in 10 years. Although I've seen stuff built shabbily enough that could happen. And yeah, I might say 15 years, but 10 years is when they're trying to sell you the loans. That's kind of the idea, is like, oh yeah, do this and this, and only 10 years we'll turn around and do this. Kind of like, it's just a nice, people like round numbers, and 10 sounds better than 20.
Well, understand. And when you said earlier about substantial rehab, right? How should developers or rehabbers think about that? Is that like a certain dollar per unit amount that they should be thinking of?
I will be completely honest. There used to be a dollar per unit minimum, and I have not looked at the updated HUD regs, but I want to say it was like 5,000 a unit minimum or something like that. The last time I looked, it's probably more than that now. I'm sure it's more than that now because it's been a while. But yeah, they just want to ensure that you're not just doing new paint, new carpet, appliances. You should do that every second or third turn of the apartment, right? Not new appliances, but carpet and paint for sure. And appliances every 5 years, in my view, if you're a responsible, affordable housing owner. You want things that last, but at the same time, you want the people that live there to recognize that you're investing in their quality of life. And one way to do that is by having really good appliances and by replacing them before they get a chance to get old and crummy. And when you go into what I think of as kind of poorer performing affordable housing projects around, one of the first things you notice is that they have either malfunctioning or very old and outdated appliances. And they're trying to get away with forcing people to use. And that both drives me crazy and makes me angry because it doesn't cost that much to give people nice counters and nice refrigerators and dishwashers. And I personally like to see washers and dryers in every unit.
That's a big quality of life difference. I mean, I don't know if anybody remembers, like I lived in an apartment building where I had to go downstairs and across the street to do laundry every single time.
Oh, me too. Oh man, when I was in law school, I had to do that. Yeah, I had to like put my stuff in a bag and go down to the washateria, and go do that. It was just so inconvenient and it takes time, and that's all anybody has is time to use in any given day. And when you could just open a door and open a washing machine and throw your stuff in and get it out in the morning or whatever and have clean towels and underwear and socks, that just makes a huge difference in how people feel when they start their day.
Yeah, and I think that translates directly to bottom line. I mean, if you can just get your vacancy a lot lower because someone has a better chance of living in your home, I mean, that's a big difference. It translates to real bottom line savings. Sometimes people think you just build a home and you set it and you forget it, but that's clearly not the case. Just think about if you're a single mom working 2 jobs and trying to put food on the table and you got to go spend an extra 30, 45 minutes just getting out of your home to do laundry. It's not the quality of life that you really want to understand. And just understand that even when we talk about affordable projects, we're talking about 60, 80% AMI, area median income. And when you're in areas in high affluent areas, these are folks making 50, 60, 80, sometimes even 100 grand a year, and they still qualify to be in these affordable units, right? So don't think for a second that these are folks that are like the projects, for lack of better words, but these are great working class people that also are just trying to put food on the table. So, Michael, educate us a little bit on what would qualify for a HUD loan. Does it have to be a certain percentage of affordable units that are set aside for based on income limits? Like what would qualify for a HUD loan?
So here's where we get into some interesting kind of hair splitting. Is what it boils down to. So in the HUD regulations, HUD defines affordable housing originally as housing intended for people who earn at or below 80% of area median income. Then later in a separate set of regs, HUD said that to be truly affordable, any rental housing should cost no more than 30% of an individual's monthly income, right? So people take those two and put them together and say, then that really means that affordable housing for purposes of HUD means intended for people, aim for 80% of AMI and charge them 30% of what 80% of AMI makes for rent. That is low income. 221D4 programs and 223F programs, but especially 221D4, because that's for new construction, is really aimed at creating housing that is affordable for low and moderate income individuals. And moderate income is another name. That's the technical HUD name for what we often hear tossed around these days as workforce housing, which is up to 120% of area median income. So if you think of the project as one where your goal is to serve primarily people, meaning more than half of the units are the rental needs of people who earn at or below 120% of area median income. And of those 50 plus percentage of the units, the majority are retained and dedicated to rental to people earning at or below 80% of area median income, you will be perfectly fine with HUD. So you meet all of the other regulatory requirements. And I think we started talking about that a little bit last time. And that's really a lot of it has to do with experience in real estate generally, experience, you have prior participation certification where you've got to have somebody that's actually closed HUD loans. And we talked about this idea of renting experience, which is a popular thing to do. And it's not an illegitimate thing to do either. It's just a technical requirement, and you can meet that technical requirement in HUD projects by acquiring that experience through contract the same way you can acquire that experience through consultants in a low-income housing tax credit context, in the context of a LIHTC application, for example.
Yeah, and I loved how you brought up the prior experience requirement, but you also made it attainable, most importantly, Michael, because for folks out there that are just starting out and they really want to make a difference with their time and energy, they're like, hey, I never done a development project, but there's so many things you can bring to the table. You can bring your relationships with the sellers, with finance. I mean, I am always very transparent with people. I'm great at finance. I'm great at underwriting. I understand how to build relationships and structure a deal creatively. That's my strength, but I know nothing about how deep the foundation needs to go. So in that situation, you got to go find someone that actually understands how to do construction. And more importantly, have done a HUD project before, because if you look back to a prior episode, you will see that we talked about how you got to have a change order, even if you just don't build for one day because it rains. Like, this stuff matters.
That's exactly right. People that think they know construction and they come in, oh, I'm not going to do that. I'm like, that's all good, man.
Well, that's so funny. And what have you seen for HUD loans? Like, how much equity do people need to bring to the closing table for these projects?
For a typical, well, as we mentioned, for a 223F, it's 75% is the maximum that you can borrow. So you got to have 25% equity of the project there. In a 221D4 new construction loan, so it's a 80-20, so you got 20% of the total value has to be in equity. And oftentimes the way that is addressed, the easiest way maybe to achieve that, instead of just having a capital raise among people generally or trying to get front money from an investor limited partner, is if you already have the land and you are essentially relying upon the value of the real estate as the basis for your equity in the transaction. That's what I've seen most frequently, to be honest.
Right. And because sometimes you have 80 or 85% loan of cost for some of these new construction loans, sometimes your land costs and the forced value you get from the entitlement process is enough to satisfy.
And also what I've seen a few times is when there has been a partnership between the developer and the general contractor. And the general contractor will take their builder profit and overhead and add that into the equity pot in order to meet the 20% requirement if you're thin on the real estate front.
Oh, I love that, because that's really creative, right? Because now you're building the GC fee into the equity stack, and they might defer it, right? But do you count that as a defer? Because I remember you saying that HUD doesn't like seeing unpaid obligations, right?
No, they don't. The HUD loan is a non-recourse obligation. So they don't want to see unpaid obligations of the project entity, because the project entity is the borrower. And they're assuming that it's a special purpose entity created just for this transaction. And so that entity is the entity to which they look for satisfaction of the loan. In the event of a default, they have to pay the lender. And then HUD turns around and comes to you and wants you to make good for what they had to pay to the lender and you'll have a HUD red flag in perpetuity until you do, so that you could never do another HUD deal. I mean, you could live in a HUD deal, but you could never even be an investor in one. You couldn't be an owner of a contracting company that was involved in a HUD deal. I mean, it's pretty comprehensive. So, yeah, the benefit that you get from this substantially below market interest rate is, yeah, we want you to do well and follow the rules. But if you don't follow the rules, we're not going to give you a second bite at the apple unless you figure out a way to make us whole.
So, Michael, you mentioned about just the creative deal structures of using a GC to contribute the GC fee. What other type of creative deal structures have you seen work to make a deal come to life, right? To essentially close on a construction loan. Are there any examples or stories that you can share with us?
Oh, sure. I've done lots of different deals. One structure that's fairly straightforward is having a mezzanine lender. We did some deals with Bank of America's CDC 20 years ago. And what they did is Bank of America funded the CDC, and the CDC, because Bank of America gets Community Reinvestment Act credit for giving it CDC money. And then that CDC took those dollars, and it's at the mezzanine level. It gives money to the managing member of a limited liability company that is the project level entity. And then that managing member injects that into the deal as equity, but it's being loaned from the CDC to the managing member at they call it a mezzanine loan because the mezzanine in a theater is one level above the floor. And so it's loaned up here, and rather than being secured by a first lien mortgage or any interest in the real estate, it's secured by the membership interest in the limited liability company that the managing member holds. So if there's a default, the CDC merely steps into the shoes of the borrower and takes over their equity position in the project. And that also gives you flexibility because if there is a default or if there's an approaching default, you have a lot of opportunities to work that out on the mezzanine level without them actually taking over that membership interest, because they have the ability to do that pretty much at any time. And so you want to forestall it if at all possible. And they frankly want to forestall it if possible, because it wasn't their goal originally to have their CDC be in a driver's seat of this thing. They just were trying to work in furtherance of their Community Reinvestment Act obligations and to help create supportive housing. But that's one we've done many, many times, a few dozen over the years. And I've done that with conventional loans. I'm not going to say you can't do it with a HUD loan. You can do it with a HUD loan, but it's got to be a pretty clean deal. Let's put it that way. Because in order to secure that membership interest, there's a pledge of the membership interest. And so HUD has to approve the UCC1 that is used as a financing statement to secure the pledge of the membership interest in that managing member of the. This is in the context of a deal where you have a limited liability company as the transactional entity, and then a separate limited liability company acts as the managing member of that transactional entity. And it is the managing membership of that second LLC that is being pledged, not membership of any of the transactional entity, because HUD would not allow that. But HUD does have to approve those financing statements. So when Jack Stark was he's still alive, thank God, but when he was still the head man for this 5-state area here at HUD, I did a little 3-hour presentation to him, kind of showing him how these things work back in around 2001 or so. And he was like, okay, let me run it up the flag here. And he took it to his regional guys, and I had to do a presentation for the secretary's representative and everything else. And they ended up saying, okay. And so we did 2 or 3 HUD deals that way. But HUD also is totally fine with mixed transactions. By that, I mean having that's not nonprofit sponsored, but there's a nonprofit participating for whatever reason, maybe just for its own purposes and serving its mission, and a for-profit developer that has done HUD deals and has HUD experience. And so we did about 113 units on Maple Avenue in Dallas that way that are very nice, that are over just probably about 2 miles from Love Field Airport, in a better neighborhood than the ones right around the airport. Those are a little sketchy, I got to be honest. So those work out well too.
And mixed transactions, when you have a nonprofit and a for-profit entity, you had to define those roles really well, I'm assuming.
Oh, big time. Yeah. I actually did a couple of continuing legal education presentations for other lawyers back in the day on the IRS limitations and guidelines on joint ventures between for-profit and nonprofit entities. And I would always, again, have to clarify, when I say nonprofit, I am meaning a 501c3 tax-exempt nonprofit. And if you ask the IRS, they'll say that their general or default position is that a tax-exempt entity and a for-profit taxable entity should never have joint ventures or partnerships. They don't say it's prohibited. They just say we advise them not to. It's just that if you are going to, you have to have a lot of guardrails for the nonprofit. The for-profit, nobody cares. But in order to protect the nonprofit, you have to ensure that the compensation and remuneration of any kind that goes to the for-profit is not ever higher than market rates. So in other words, the for-profit cannot profiteer from the tax-exempt status of the nonprofit organization in order to gain greater than market level returns on its investment, because that would constitute private benefit, which is prohibited under the IRS regulations. And if you're an insider, the nonprofit, like a board member or a staff member or an executive director, then instead of it being called private benefit, if you get anything that's greater than market rate, it's called inurement. And that's equally prohibited and bad. and frankly, there's a lot of that going. And I will also tell you this is just kind of an aside. It's kind of gives you my insight into some of the subject matter, but that is the explicit and specific reason why the vast majority of churches in America are not incorporated as nonprofit tax-exempt organizations, especially non-denominational ones, because then their pastors, televangelists, for example, would not be allowed to gain greater than market rate compensation for running a church. The kind of scam that I see that most pastors do, most of the televangelist pastors do, is they say, oh, but Pastor so-and-so, he doesn't even take a salary from the church. He only makes money from selling his books. But the deal is they make it pretty clear as part of their liturgy, essentially, that you're not a really good member of their church unless you buy the pastor's books. So it's another form of contribution to the church when people are buying these books. And that's how these guys are making.
So I guess to talk about the people that want to do it right? They want to have a nonprofit, but you still need some money to put food on the table. You can't do everything for free.
Yes. Oh, yeah. If you're a bona fide nonprofit, if you're a legitimate nonprofit, one of the things you do, and that you're actually unwise and probably negligent if you fail to do, is you conduct a salary survey every year. I was in charge of setting those up for many nonprofit housing groups back in the late 90s and early 2000s, because there were government people that were saying, well, this guy is being paid $200,000 a year, and this is a nonprofit, and I think that's wrong. And I said, no. Hang on here. This isn't a church. This is an affordable housing developer. You show me the CEO of a real estate development group that builds 1,000 units a year that's making $200,000 a year. You won't find one. They're making $1 million a year. 20 years ago, they were making $1 million a year. So, I got my salary surveys to show you that my guy, he's making enough money to take care of himself and his family, but he's also helping to provide housing for ultimately tens of thousands of people in these apartment projects at affordable rates. And he's entitled to be compensated, not what nonprofit people similarly situated are paid, but what people in any market-driven compensation scheme for the kind of work that he or she does is compensated. And there are actually nowadays, because the world is so digitized, there are a lot of online resources for salary survey data that you can get to be able to compare and say, okay, here's the average, here's the mean and the median of what people are paid in an organization that has 50 or fewer employees, that has $25 million or less in annual revenue. And it'll have by category, the kind of thing. And here's how much they make. And those are helpful. So it's a completely normal expectation and an appropriate expectation to say, I want to start a nonprofit, or I want to have a nonprofit, I want to work for a nonprofit, but I want to be paid a decent wage, a decent amount. That's cool. It should be that way.
I completely agree, because you got to take care of the people.
Yeah, exactly. It gets out of control sometimes. I mean, you can't compare running a nonprofit to running a corporation when it's primarily a nonprofit. If you have a housing group, housing, for-profit or nonprofit, you're building apartments, you're doing very similar work. When your primary goal is being an umbrella to a bunch of nonprofits, many of which are things like heart associations and the American Cancer Society and all these other kind of United Way, to me, it's hard to compare, apples to apples. If you're saying, yeah, but what the guy that's the chairman of JP Morgan makes or whatever. But that guy, the IRS said, no, you can't do that. But the reason it was very political, because it wasn't just, we think he's making too much money. It's that the reason everybody found out how much he was actually making is that he was taking money that wasn't being reported for compensation and using it to pay for an apartment in Washington, D.C. And he was like 53 or something, where he was keeping his 17-year-old girlfriend. Very salacious. Yeah, when you got a salacious story, people like to see people get burned, and he did. So.
Okay, so I guess the takeaway
that has nothing.
But it just got to be commensurate with what the market expects. And you brought a couple of factors. You talked about unit count. You talked about the number of units you're responsible for building or overseeing. You talked about whether or not you're a board member compared to like the president, et cetera, because you got to have apples to apples comparison. And there's always groups that you can hire to do it. And really, the study is meant for, Michael, if I understand you correctly, is you want to have that doc. It doesn't mean that the IRS is going to be checking on you every single year, but you want to have that document justified.
I mean, so the reality is that in any given year, there are something like 10,000 new nonprofits created. And there are already hundreds of thousands that are created, because when you think about it, every YMCA, every YWCA, those are nonprofits. Every Girl Scout and Boy Scout troop is a nonprofit. There are many denominational churches that are actually exempt and C3s and incorporated. There are, maybe you would guess this, but I used to ask people all the time, what do you think there are more nonprofits that do than anything else?
What is that?
Animal rescue. Oh. There are more dog and cat, but especially dog rescue nonprofits in America than all other nonprofits. I mean, it's crazy. I mean, there's something like 10,000 animal nonprofits just in Texas. Wow. And I know in California, has many times more than we do. Yeah, it's crazy. And I know so many people that have these nonprofits. I sit on the board of one in California, but people come to me, I've been thinking, I thought I might want to start a nonprofit. Really? To do what? Well, I really want to do rescues. Like, really? Are you kidding me? It's like, there's like 5 on your block. I mean, why don't you go volunteer at one that's already around? And there are many of those that are what I call vanity nonprofits. There are a lot of people, especially kind of upwardly mobile women, that like to have their own pet charity that they want to create for themselves so that they can identify. And especially now that we're in the age of Instagram, that's like, here I am at my nonprofit's event. And it's like, yeah. I'm sure you're doing great things.
All right. Now that we just got a big deep dive on nonprofits, dude, that was so educational. Thank you so much for talking about that.
Yeah.
Because one of our biggest topics that people actually come and ask us about is like, hey, what are nonprofits? How do I do this correctly? But man, it's just so simple. You can set up a nonprofit really easily. You just want to keep everything kosher and make sure that you're sticking with that mission. And maybe I'll ask you one more question, right? Typically, well, real estate is generally not a nonprofit activity, right? What type of considerations should people have whenever they're forming a nonprofit for the purpose of creating or buying or holding real estate for like affordable housing or a specific population? What else should they really know about to qualify for that nonprofit or tax exempt status when it comes to real estate?
There used to be a Treasury regulation that provided a safe harbor for affordable housing. And then on top of that, the various federal courts around the country have included some additional considerations. For example, there is just this past year, they updated the safe harbor, and it didn't used to address LIHTC deals. It used to just say, if you're a nonprofit involved in affordable housing, you have to have at least 40% of your units have to be leased to people at affordable rates. And within that 40% affordability component, half should be to people at or below 40% of area median income. Okay, that was the old one. Now, they didn't specifically overrule that, but since there is a general awareness now and a recognition that the low-income housing tax credit provided by Section 42 is the predominant, not exclusive, but predominant by far means of creating affordable housing, the IRS created this new safe harbor specifically for tax-exempt organizations involved in LIHTC deals. And it's twofold. It has guidelines for newly formed organizations as well as standards for anybody that's nonprofit that's involved. And they're pretty specific. So they say, for example, if you're tax exempt and you are involved in a LIHTC deal, you have to have not just any nonprofit, but you as the tax exempt entity involved in this Section 42 deal has to have a right of first refusal at the end of the initial compliance period. So in case people are not aware generally, when the tax credit was first created in 1986 and up until about 2010, there was a 15-year compliance period. So the idea was that you had to have the units affordable for 15 years and you would earn that tax credit over a 10-year period. So you had 5 years after your credits were all used up that you still had to be affordable. So you essentially had a 1/3 accelerated earnout of the credits instead of having the credits accrue year by year based on affordability. Then, because people were concerned that there were for-profit developers that were involved in these projects that were buying out projects at the end of the initial compliance period and turning these into non-affordable units and reaping benefits that accrue from the original tax credit financing, they said, you know what, we're going to mandate an additional extended compliance period of another 15 years. So now technically the full compliance period is 30 years, but it's still two separate compliance periods. It's an initial compliance period of 15 years and an extended compliance period of 15 years. At the end of the first 15 years, that is when the first right of refusal may be exercised at the first time. The first right of refusal says that the investor that has purchased those tax credits under the terms of the used to be limited partnership agreement, now it's a limited liability company agreement, agrees to offer their interest to what the Internal Revenue Code says in Section 42 is either to the government or to a tax-exempt entity first. And then if neither of those wants it, they could sell it to a third party, right? For only there and then existing indebtedness and exit taxes. And the exit taxes are the taxes that the for-profit investor would incur by virtue of leaving the partnership. And it's typically a relatively small amount of phantom income that they are deemed to have received. So now the safe harbor that came out didn't change Section 42, but it says if you're a nonprofit and you're involved, that you have to be the one that not only is given the right of first refusal, but you essentially have to be guaranteeing that you will repurchase that interest. And you have to manage the tax credit partnership in accordance with your charitable mission. So that part's not very onerous. But if the tax exempt entity provides an operating deficit guarantee, its guarantee must be limited to a period not more than 5 years from the date the project achieves break-even operations. Or alternatively, the total amount of the guarantee should not exceed 6 months of operating expenses.
But that's a nonprofit that has to guarantee that portion for their participation in the LIHTC.
Yeah, but the reason that I think that's important is, like, I don't remember if I mentioned this or not, but I was heading the real estate development group at a significant nonprofit on the East Coast a couple of years ago, and a large national bank was the tax credit investor, and they required not the tax credit entity, but the nonprofit to guarantee completion, operating deficits. They required the nonprofit to guarantee every general partner obligation for an unlimited period. So it's like they violated the safe harbor right there. And I told the executive director that A, that was impermissible under tax rules, but B, it was also just stupid, because it essentially meant that the nonprofit had unlimited liability. And if you're going to erase the limits of liability, there's no reason to even have the facade of a limited liability company involved in the transaction. You might as well just make the nonprofit the general partner of the deal if they're guaranteeing all the general partner's obligations in an unlimited way. And he respectfully disagreed, which, I mean, it's like disagreeing about what the boiling point of water is. And so I said, at the very least, in order to avoid really malfeasance, if not criminality, you have to explicitly disclose that choice to the board and allow them to approve you doing that. And he didn't disclose it. He didn't do anything. And that's when I said, I'm leaving. I can't be around people like this. And it was because he just wanted the deal so bad. He knew it wasn't going to happen, or at least he wasn't nervy enough to tell the bank, go jump in the lake. And I was happy to do that, because if we'd have told them go jump in the lake, it would have meant we were dead for that cycle and we would have had to wait a year to close that deal. But I'd rather wait a year to close the deal than we already own the land. Wait a year to close the deal than do it the wrong way.
Yeah, so I can see why pressure in that situation led them to make that decision.
And that's part of the reason that rule came about.
And I hope that people really take that ramification under careful consideration, because that's significant amount of liability that you're taking on as a nonprofit to guarantee the performance, essentially everything for that project. It's a significant risk. And if it doesn't go well, I mean, that nonprofit can very much go out of business. And I'm not even sure what the financial ramification is for the employees or the board members, but it sounds like they're guaranteeing it.
Yeah. So they also put in there, they kind of changed the safe harbor on the units. So they're trying to create at least the appearance of some spectrum of income. So 75% of the units have to be available to people earning 60% or less of the area's median income. And of the other 25%, they have to be lower than that. They've got to be either low or very low income.
So that's like 100% affordable. And so if I say it back to you, 75% of units have to be 60% AMI, and the other 25% probably is like 50 or lower, I'm guessing, right?
If it's a nonprofit deal. Yeah.
Okay.
For a for-profit deal, you can have market units. I've had market units on the tax-exempt organization involved deals in the past before this. It's not a revenue ruling, is it? It's a regulation. But this is very interesting to me. So part of the regulation came out and said that if it's a LIHTC entity that has a tax-exempt entity tied up in it, that they must enter into a fixed price construction contract. And I find that interesting, because during the pandemic, and now we're back to kind of pretty normal to fixed price, I'd say things are expensive, but fixed price deals are doable. There was a period of a couple of years where you couldn't do a fixed price deal because costs would change from the time you closed until the time that you commenced construction, much less completed construction. So you had to have a cost plus because there wasn't a way to build enough contingency into a fixed price, a standard AIA fixed price contract to be able to cover that. So you would have to have a separate side agreement that would be one of these cost, they call them cost engineering. It's supposed to be, we share savings, but there's no savings. It's basically, we prorate losses between us for excess costs over and above the fixed price of the contract. Because if you put 100% of that cost on the LIHTC entity and have the contractor accept none of it, you'd never get anything built.
Right. And no builder is going to sign up for a deal where they might lose their shirts.
Exactly.
They're not silly. So I want to end this podcast just by re-emphasizing what we just talked about. For 75% of units have to be 60% AMI and the other 25% have to be 50%. That's only for nonprofit. That has nothing to do with the HUD loans.
And let me say this, that's the safe harbor. So what that means is if you follow that, you don't have to do anything else to protect your tax exempt status. You don't have to meet the safe harbor in order to continue and protect your tax exempt status. There are other factors to consider. Just like under the old safe harbor, you got to consider multiple other factors, including things like what services were provided to people. Were a percentage of the units set aside for seniors? Were a percentage of the units set aside for persons with disabilities? Were you serving a targeted, marginalized community? Did you have a significant number of people in the community, in the LGBTQ community, that were residents there? Did you have communities of color or of marginalized ethnicities that were there? All those things, if you met many of those other things, you don't have to meet the safe harbor. You could not do what the safe harbor says when you're doing these other things that demonstrate your charitable intent and mission orientation and still be completely fine. You just have to have a qualified and competent tax lawyer advising you, which is what I used to do. Tell people, no, you can't do that. Yes, you can do that. And I would give them a reliance letter saying, if you do X, Y, and Z, you can rely on this in closing this deal and your tax exempt status will be safe. And it creates kind of an estoppel with the IRS, because if the IRS ever did initiate an audit, which they never did once in a million years of doing that, you could turn around and take that letter and say, we relied upon our lawyer's recommendation. Now, you can't do that in many situations legally. It's like, I know with some of the national political legal things going on, the big defense was, I didn't answer that subpoena because my lawyer told me I didn't have to. Well, that doesn't work. Subpoena's a subpoena. But if you're saying, yeah, I think we can enter into this partnership because I got an opinion from our law firm that says we're okay with that, that's no different than the hundreds of opinions that my firm gave to the federal government and state government and housing agencies and lenders and investors and everybody else, saying that these documents were duly executed and they are the binding obligations of the party that we represent, and they were enforceable in accordance with their terms. And so those enforceability opinions are a big part of reliance in closing for folks, because they say, okay, lawyers that know what they're talking about have looked at this stuff and said, yeah, we're okay to do this. It's very similar with the IRS. If the IRS says, oh, okay, yeah, we know them. Yeah, we worked with them. Yeah, they said it was okay for you. So as long as you really did those things, now instead of questioning anything else, our only question will be, did you actually do the things that he said you had to do in the letter? And then that's the limit of their investigation.
Got it. And Michael, obviously this is not legal investment advice or financial advice, full disclaimer that. No. But Michael, for people that want to find a tax attorney that understands this stuff, man, how do they figure out if they're talking to the right attorney that actually knows what they're talking about? Because that's the hardest part. People can talk, but how does someone know they have knowledge like you?
It is a very small, and I'm not being sexist when I use this term, I was going to say it's a very small fraternity. It's a fraternity that includes some women lawyers. One of the best women lawyers that I know who was in this field actually left. She was in Atlanta. She left, quit practicing, and went and started a hedge fund. So what I would do is, ask whatever lawyer you're talking to. Generally, that knows a bit, if you found somebody that knows about tax credit development and affordable housing generally, ask them specifically if they have somebody they can refer you for tax purposes relative to nonprofit stuff. And then if you don't know, people should just look me up, contact me. I'm not trying to solicit business. I don't want the business. I'm saying I'll refer you to somebody wherever you live that's good, because there are less than 25 lawyers in the entire United States that are really good at this. Seriously. In about 2004, when things were kind of at their height, there were not even 10 of us. And one legislative hearing that was in front of the United States House of Representatives, somebody from the Internal Revenue Service said they thought that there were about 4 of us, and I was one of them. And one of them was a guy in California, one of them was a guy in Boston, and one of them was a guy in South Carolina. There was a guy before me that was in Houston, very good lawyer, very excellent transaction lawyer, did tax work, but wasn't really a tax lawyer, but he was very good. And I would tell people to call him, but he retired. This is not the kind of thing that has sex appeal for young lawyers, to be perfectly honest. They get out and it's like, okay, I want to do X, Y, and Z. And this stuff is complicated. And depending upon the clients that you have, it may be something that most larger firms or even medium-sized firms don't have much interest in cultivating. They would much rather represent banks and investors or construction companies than represent individual developers. There are some firms that do great development work in the affordable housing field. There are a lot more of them than there are good tax lawyers. There's hundreds of those firms, I would say. But a lot of them are good because they're also good governmental relations firms, because you have to be good at governmental relations to handle the annual or biannual qualified allocation plan wrangling that happens in every legislature and in every state housing organization, and interacting with those people and having good rapport with the staff at the state housing agency is important. But when it comes to tax stuff, it's tough. There are tax firms around, but there was a guy who's with Polsinelli and White in their Kansas City office, and he used to have a thing every year at our big tax lawyers American Bar Association confab that was an update on exempt organizations. And he was a good guy, good lawyer. He's pretty full of himself because he wrote his own introduction. And I remember the introduction said, he has an encyclopedic knowledge of all things related. I was like, you wrote that yourself? Man, that's kind of, come on. I have an encyclopedic knowledge. Anyway, so just to kind of prove my point, I asked a very pointed question about something related to safe harbor variations for affordable housing at one of our American Bar Association convention things, and gave it to him because he was answering all these, and he had no idea. And this guy was supposed to be the expert, you know. I was like, man, if there's a whole room of nothing but tax lawyers, and this guy is supposed to be the tax-exempt tax lawyer, and he didn't know. And that's when I really knew that, man, I'm in a distinct minority. I didn't get this way because I wanted to be in a minority. It's because when I started out representing community development corporations, I had a background in tax and finance and securities. And so it made me interested in that aspect of things. But also, one of the things that I've always done with every organization that I've worked with, is for-profit or nonprofit, and maybe it's part of the reason I like being a professor, is I grade papers. I look at the work other people have done before, and I say, man, they did not do a very good job setting up your corporation or your organization or your nonprofit, and here's what's wrong with it. And so my kids always say that I'm kind of negative in the way I approach these things. I tried to figure out the worst thing that can happen, and through documentation and structure, preclude that occurrence, right? So if you prevent the worst outcome, ultimately by default, you'll get a better outcome. And that works for me. You know, maybe that's a dark way of approaching things, but for me, it's much more practical than saying, oh, I want to write things so I have the best outcome, because then you have potholes that you forget about. I want to cover all the potholes so that there aren't any potholes. And so when you get down to it, it's like, okay, so we don't have a safe harbor issue. We don't have enormous issues. We don't have private benefit issues. We've got salary. We're doing everything we're supposed to do with respect to our set asides. We're doing everything we're supposed to do with respect to our contracts. We haven't guaranteed anything. And let me be clear about this too. The reason that Safe Harbor talks about those operating deficit guarantees is if you have perpetual or overly long guarantees, you are essentially guaranteeing a potential loss that is to your detriment, but is to the benefit of a for-profit taxable investor. And so it's an indirect but very clear form of private benefit. And that's why things like guarantees have to be analyzed fairly scrupulously in figuring these things out.
Wow, Michael, it's been an honor to have you on the podcast just to talk about this piece, because this is the number one topic that people would ask me about all the time about nonprofits. And I was like, I definitely am not the expert. And to hear from you, that's probably only 1 in 25. You're 1 of 25 people in a whole country, probably less than that now, that actually knows this stuff.
I say 25 now because I think there's more. Because I think that starting about 2010, I think that there were people that were tax lawyers that started paying more attention to this. And I think there were also people that were affordable housing lawyers that started realizing they needed to gain some expertise in tax that they didn't have. There was actually a young lady, she may not be that young anymore, she seemed very young to me, but she was with a large national firm that has a substantial presence in Texas. And she was in their Austin office, and she worked representing the state housing agency on bond issuance. But she was a transactional lawyer. And she was a very good lawyer, nose to the grindstone, very by the book. And there was a guy that was there that was a tax partner that would come in and do the tax work on these bond deals. And his wife was an academic, and she got a job in Australia. So they left. Instead of taking another tax partner and saying, we want you to start doing this work on these bond financings, they took this young woman that had been a transaction lawyer and told her they wanted her to become a tax lawyer. And so she did a bunch of, I think she actually went back and took some law school classes. I know she did a bunch of CLEs. She talked to me and some other people. And before long, she was the one who was calculating the arbitrage amounts and drafting the no arbitrage agreements and calculating defeasance on bonds that were being retired and doing all the numbers work that you have to do from a tax perspective. And she's their tax partner now on all those things. And I think that, as unusual as it seemed at the time, I think that's been replicated in some other firms around. That's why I say 25. Yeah, I may be underestimating. But when I go to bar functions, like national bar functions, if I'm in DC and I tell somebody and I'm surrounded by 1,000 lawyers and I tell them what I'm doing, invariably, I'm the only guy in the room that does what I do. They're like, yeah, you ought to go over that Admiralty guy over there. Nobody does what he does either. Kind of jokingly, but not really jokingly. So my dad was a lawyer. And when he was older, we went to State Bar of Texas convention together when it was in Dallas. And it was a highlight of my life to be able to bring my dad to that, because he'd been long retired and he was an older gentleman. And when we were walking in, he said, you know what we got to do? And I said, what's that? And he goes, we have to find the Admiralty section. I was like, why do we want to find the Admiralty section? And he said, are you kidding? I was like, no, why? And he goes, Admiralty lawyers make more money than anybody. No one knows what they do when they represent these giant shipping companies. They make zillions of dollars, and they always have the best hospitality suite. And so he was right. We went in there and they had lobster. I mean, they had like lobster and champagne.
I would have never guessed. Oh my!
I would have never thought about it. Yeah, Admiralty law is crazy, but it's all shipping stuff. You know, it's all the law of the sea. They do stuff on the high seas, but really a bulk of what they do is interactions between very large shipping companies and insurance companies that insure lost cargo and damaged cargo. And so when you're talking about ships that are moving tens of thousands of automobiles a year, or millions of tons of grain, or airplane parts. And ironically, my daughter works for a logistics company, and she's one of their seagoing freight specialists. So she's in charge of doing all the customs and freight calculations and invoicing for stuff that's seagoing. And I always think of that. I was like, you ought to make more money.
Michael, I'm so glad. I mean, I learned so much from you every time I talk with you, Michael, and I can't wait. I think we can easily have a series going forward about just how to set up a nonprofit or tax-exempt entity correctly. And
Oh, sure.
definitely cover
I think that'd be
next time
very
too.
good. I'd love to do that. That would be helpful. And I think that would be really beneficial to a lot of people because I've set up so many nonprofits for so many different reasons that not just housing. I mean, there are so many people that need so much support and help in this world generally. And I see people, I have girls that I taught when I taught in Bangladesh who still stay in touch with me that are working now themselves, creating nonprofits to help all sorts of, some of them are girls that are from Afghanistan, and one of them has a nonprofit that's just to support Afghan refugees in America. Another one has a nonprofit that she started while she's in graduate school with a little bit of help from me to raise money and help take care of people for hospitalization costs that are in occupied parts of Gaza. Not that they'll ever see the money anytime soon, sadly. I mean, there are so many people on the planet need help. What expertise I have, if I'm able to disperse it in a way that it encourages people and helps people to focus in ways that they can be of use to others, I think that's a gift.
I know that for a fact that would be a gift. And Michael, I'm so grateful for you coming on to the podcast again today. Thank you so much for what you do. Without people like you, I would never had the.
I appreciate it, Ken.
Thank you so much, Michael. And I'm going to wrap this podcast up, but we're going to bring you back on for a series, just talk about LIHTC and also another series talking about how to set up a nonprofit tax.
And you'll probably say, try not to get off the track so much instead.
I love these stories. Are you kidding me?
Oh,
these are the best conversations.
I can tell stories all day. That's for sure.
I love it. All right. And we are out for today.